Hello, and welcome to Wealth Management Insights. I'm Steve Edwards, Head of Portfolio Construction and Cross-Asset Strategy for Morgan Stanley Wealth Management. This episode marks the first in a series that will focus on concentrated equity and its implications for investors' portfolios. As a starter, we define concentrated equity as any group of 5 or fewer stock holdings that collectively contribute more than 30% to portfolio level risk. Many investors have become wealthy because of single name positions that have appreciated in value and come to represent a substantial portion of their overall wealth. What may once have served as a blessing, given outsized returns, can become an anchor, as the concentrated position's risk potentially exposes investors to sustained underperformance, elevated volatility, and material drawdowns. In turn, concentrated equity positions pose a challenge for investors, severely limiting their portfolio's prospective risk-adjusted returns. Next, let's consider volatility and material drawdown risk. Since 2014, for individual stocks in the Russell 1000 index, the average volatility has measured 37% compared to just 15% for the index overall. Both are annualized figures. Moreover, the average stock has suffered a maximum drawdown of 50%, double that of the index's 25% maximum drawdown. What's more, 85% of stocks experienced a larger drawdown than the Russell 1000 itself over this period. Of the stocks that suffered a catastrophic loss over the past 10 years, which we define as a 50% peak to trough drawdown, close to 40% of those never recovered fully. Such adverse outcomes could materially diminish an investor's wealth, especially in the case of concentrated positions. Now let's turn towards individual stock performance relative to that of the broader market. From a return perspective, most stocks underperform their reference index's risk-adjusted returns over short and longer historical timeframes. These results appear consistent across timeframes and investment horizons. And stocks that have outperformed over a given period tend to disappoint in the subsequent period. That underscores how the blessing of outsized returns that may have led to the concentrated equity positions in the first place may turn mixed in the future. Taken together, all these implications demonstrate that investors do not receive due compensation on average for holding concentrated equity positions. This observation remains valid across the measures of risk that we've discussed, including volatility and drawdowns. These realities underscore the benefits of diversification for long-term investors. Now that we've thoroughly established the challenges associated with concentrated positions, I would like to offer a brief introduction to our proprietary equity vulnerability score. This tool is a risk-managed focused tool, offering a quantitative factor-based ranking of U.S. stocks' relative vulnerability to future drawdowns. It complements our existing tactical equity framework, which looks at stocks' fundamental and technical characteristics. We have found that more vulnerable positions tend to have less stable financial results, diminishing fundamental momentum, and greater susceptibility to volatility and tail risk. Based on our historical testing, those stocks that have scored as more vulnerable have demonstrated notably higher drawdowns in future periods. We found these results to hold for the volatile start to 2025. As a result, we believe that the equity vulnerability score, coupled with broad risk concerns for concentrated equity positions to begin with, can point to those positions that warrant deeper attention as diversification candidates. We have found that the tactical equity framework and the equity vulnerability score work well together for equity portfolio management. Combining the two could support more risk-sensitive management for diversified U.S. equity portfolios and identify potential vulnerability for holders of concentrated equity positions. Thank you for listening. For a more in-depth discussion on the potential ramifications of holding concentrated equity positions, including a deeper dive into our methodology, please reach out to your Morgan Stanley financial advisor for a copy of our report called Confronting the Concentrated Equity Challenge and Measuring Drawdown Vulnerability. Please stay tuned for more information on how diversification strategies can help you to mitigate the systematic and idiosyncratic risks of concentrated equity positions in investor portfolios. Thank you.